In this video, I'm going to walk you through the negotiation process for a typical merger. We're going to go through each one of these steps one by one. So let's start with the initial approach. So it could be initiated by either the buyer or the seller. So the buyer is you've got some company that says, hey, listen, I'm interested in acquiring company X over here. And so the buyer's management would contact the target company's management and let them know that, hey, we're interested in buying your company. Now, the selling company, so it doesn't have to be that a buyer approaches the seller. It could be that there's a seller, a company that says, look, we'd really like some other firm to acquire us. And so we're going to hire an investment banking firm. Maybe we hire Goldman Sachs to identify some companies that might be interested in buying us. Now, when the seller is trying to get sold, they could say, okay, well, we want to attract interest from a whole bunch of bidders, and we're going to have an auction. We're going to have an auction to see if we can get the best price. Or sometimes when you have this initial approach process, it's really just one buyer that the seller is negotiating with. So it could go a number of different ways. Now, the approach could be friendly or hostile. Hostile, if you ever hear about, oh, this company tried to do a hostile takeover, what they're talking about when they say hostile is that the management of the target company does not want the takeover to take place. They don't, for whatever reason, they don't want that buying company to be the one that does the takeover. Maybe they want some other company, or maybe they don't want to be taken over at all. But for whatever reason, Target's management is trying to oppose this. It doesn't mean that the deal isn't going to go through, because ultimately it's up to the shareholders of the target company. So they get the vote. They're the true owners of the firm. Okay. Now, after we've got this initial approach, what you typically have happen is some kind of NDA, non-disclosure agreement, is signed, because the buying company, right, they're interested in buying, they want as much information about the target company as they can get. So they're going to want some information that might not be public. Okay, so they say, okay, well, we're getting very private information here, and the target is in a vulnerable position. So they're going to say, well, we want to make sure that once you have this information, you don't go and somehow disclose that or do something that would harm the target company. So if we're going to give you access to inside information that's not public, you have to sign a non-disclosure agreement so we know that you're not going to turn around and make this public. Now, then the buying company, they would be conducting their due diligence, looking at the financials of this target company, all these disclosures that they're getting, these non-public disclosures. They're going to look and say, okay, is there something there that lets us know, wait a minute, we actually do not want to take over this company? Okay, so they're going to do their due diligence process. And then if they're happy with what they find, then there's going to be an offer. Now, the offer, typically you have this thing called a term sheet. Okay, so the term sheet is basically what it sounds like. It's setting out the terms of the deal. You say, well, what are the terms? Well, the purchase price is obviously very important. Say, how much are we going to be paying for this company? And then the type of consideration has to do, is this going to be a stock deal? Is the buyer offering shares of its own stock for the target to acquire the target company? Or are they offering all cash? Is it a combination of cash and stock? Is the consideration variable? Maybe we say, okay, well, we're offering $8 billion, but we're going to have some kind of contingency where if this contingency happens, it could be more than $8 billion. So what exactly is the buyer willing to pay, and how are they going to pay? Now, after the term sheet, so you sometimes have this thing called a letter of intent that lays out additional details. But that's not mandatory, but sometimes companies, the buyer would issue this letter of intent as well. Now, the target's board of directors, okay? So now the company that is going to be acquired potentially, their board will sometimes hire this company to do what's called a fairness opinion. Okay, what the fairness opinion is, it basically looks and says, oh, okay, so this buyer is offering $8 billion of cash, and they will go and say, okay, does that seem like a fair price? Does that seem like a fair price to the shareholders of the target company? If they're getting this $8 billion, does that seem like a fair price for this company? To basically make it out like the target shareholders aren't getting screwed. Why would the target's board want to do this? Well, maybe the board is worried if the offer isn't that good, they might get sued or something like that. So it's common to sometimes have this fairness opinion. There are companies that's all they do is they issue fairness opinions. So now, so we've got the term sheet, we got a letter of intent, and then now we can have a formal merger agreement, assuming things have not broken down by this point in time. If everything's good at this point and things are progressing, okay, now we have basically the legal team for each of the different companies, the buyer and the target. They're going to go back and forth to basically hammer out the terms of the agreement. Maybe they make some changes to what was in the initial offer. And typically, there'll be this material adverse event clause. What that is it says, okay, so there'll be like a clause in this agreement that says, listen, so we're entering into this agreement. The buyer's entering into this agreement to take over the target. But it's not like this is going to happen today, right? It's going to take months. We're going to get to that, regulatory approval, all that. And so if something happens, something bad, there's some kind of bad event that happens before the deal completely closes, it gives the buyer the chance to just back out and just say, you know what? Yes, we're entering into this agreement to take over the firm. Here's the purchase price. All this stuff has been set. But if something really bad happens, this event happens or this or that, then we can go and say, you know what, we rescind the offer. We're not merging with this other company. Okay. Now, once we've got all that done, we've hammered out the terms of the merger agreement and so forth. Now we need approval from the shareholders of the target company. Because remember, the shareholders of the target company, that company is being acquired. And so the shareholders are ultimately the ones that are going to get the cash or stock of the acquiring firm and so forth. So these shareholders of the target, they are the owners of that target, okay? Not management of the target. It's the shareholders are the proper owners. So the shareholders are going to get to vote on whether they want the deal to go through. And then the government might have a say in terms of maybe they think that, oh, you know what, if these two companies merged, maybe we'd have some antitrust concerns. Maybe we think that it would reduce competition way too. Maybe the two companies are competitors, and they say if they were to merge, it would reduce competition and make it unfair for consumers. Prices might go up too high. So sometimes, the government will actually come in and block a deal. And to say the companies are actually happy with the deal, but the government comes in and blocks the deal and says, listen, we're not approving this. Maybe in the U.S., like the Department of Justice or Federal Trade Commission might get involved and block the deal. So once this has all happened, we've got approval from the government, shareholders, all this stuff has been hammered out, then you've got a merger.